Hi, everybody. Welcome. Thanks for joining us today. My name is Wes Burke. I've been in real estate here locally in San Luis Obispo for over 20 years. I ran the largest independent real estate brokerage on the Central Coast for a large number of those years, Patterson Realty. And during that time, I had the good fortune to get to know Jason Grote and his team over at Central Coast Lending. They were, in fact, a big part of our operations in our offices. Jason would come to our weekly meetings and give us the mortgage updates. And many of my agents ended up doing business with Jason and CCL. And that's because they are the biggest local independent mortgage company on the Central Coast. But above and beyond that, they're just really great guys. They're not out there to sell products. They are there to help people with the American dream. They're very honest and they're very diligent, and they're just a great crew to work with. Not long ago, Jason approached me about kind of taking a new angle. He's had some experience recently in the reverse mortgage market and has been able to really help some folks out with this product. And it's struck him that it would be worth an effort to really put out some information about this product, because there's so many things that are misunderstood about reverse mortgages and the reverse mortgage market. And we're here to tackle some of those myths today and to begin to lay an educational foundation about what these products really are and how they might be able to help people. So our goal today is to cut through that confusion and to have just a conversation where we can start to tackle some of this stuff. I will let you know that we will preserve about 15 minutes at the end of the presentation for questions and answers. So if you have any questions during the presentation, you can go ahead and type them in the chat, and we will tackle them at the very end. So with all of that said, Jason, thanks for being here. This is going to be fun. Would you like to introduce yourself and tell us a little bit about you?
Wes, that was a better intro than I thought you were going to do. This is our first webinar. My business partner and I, Dan Podesta, we started Central Coast Lending in 2008, which you guys probably remember was a tumultuous time in the economy in general, but that was a tough time in the real estate and loan industry. As we were a new company, we were looking to establish ourselves, and we looked at all the different ways that people could get their message out. You know, you can buy a television commercial to air during Jeopardy. You can run an ad in the New Times or in the Tribune. You can hang flyers on under windshield wipers on cars. You can put door knob hangers on people's homes. There's a lot. There's a kind of an endless way that you can market yourself. And as I say that, I kind of laugh because I think we tried most of those things. But where we always ran dry was it's hard to convey yourself, to get credibility, to really spread the message that you want to get out there in 30-second sound bites or little articles written here and there. So as a result, Dan and I started doing a radio show on the local AM radio, KVC, Mortgage Matters. I think we aired our first episode of that in early 2009, I believe. And we still do it today. So it's been, and you know, I guess I should, the reason I bring that up is that format was determined to be what was best for us, because we started out with a half an hour where we could develop a topic, you know, and kind of demonstrate that we are experts in what we do, that we can express ourselves simply and clearly. And that has really manifested itself in the way that we've done business through the years. The radio show went on to be a 2-hour radio show for a while. We had years of great guests and great content. We learned so much. We developed a pretty loyal listenership and a lot of good relationships in our local community. Today, the radio show still runs. It's only an hour. But, you know, the point of it is that it's been what we've determined to be the best way to reach people I still am an originating loan officer. I meet with clients daily and take loan applications and, kind of give advice and help sort through what options are. And I find that I'm pretty confident to say that I'm an expert in this. I joke that if there was a mortgage Jeopardy, I might win. I have a pretty darn good memory, and I have a lot of underwriting guidelines trapped in my head, but knowledge of a lot of different programs and the way that our company is structured. We're a direct lender, VA and HUD approved, which means we can do almost every type of loan, and we have through the years. So, bottom line is, I wanted to start into this aspect of trying to reach a broader community by doing some of these kinds of educational services and in the way that I really run my business, which is my goal is to be the expert with the information and facilitate a conversation where we can separate fact from fiction and help people make the decisions that are best for them, and their future, their family, whatever's important to them. And so that's why we're here. Specifically on the topic of reverse mortgages, here's what happened. I did the very first reverse mortgage I ever did was probably back in 2011 or so. Um, Admittedly a new product to me, probably a little bit overwhelming. There's always been people within the community, within the lending community, that say, well, I'm the reverse mortgage person. And for us normal loan officers looking at them going, well, they really must have learned a lot to be the expert at that product because it seems very complicated. And I would admit too that I thought, well, I don't probably want to dabble in that. It seems like a pretty controversial program. There's of course the Magnum PI guy comes on the TV and in that real assuring way talks to seniors about what they could or should be doing. But I found that when you talk to people in the community, it's not a very well received product. There's a lot of preconceived notions about whether or not this is a good loan program, whether or not it's something that people should consider. And what I learned recently, like in the last 5 to 10 years, is that when people find themselves in a position where they might need a reverse mortgage, it's oftentimes a tough conversation for them to initiate. There's sort of a shame that they found themselves in a situation where they didn't pay their home off, and now here they are looking to bleed this last asset they have out of its rest of its equity as a result of their poor financial planning. And so my career sort of led me into learning more about this program and doing more of the consultations and spending more time with these people. I spent 10 years, on the radio and telling people is like, well, it's probably one of the most misunderstood loan programs there are. We certainly don't run around pitching it like it's the perfect solution for everybody. In fact, I would almost suggest that, in my estimation of it, for most people, reverse mortgage is probably going to be a last resort. But I'm on a mission now of making sure that people can have an honest conversation about it. What is the truth? How does it work? What does it entail? Is it something that we should all be afraid of? And if somebody mentions it, we should immediately begin to discourage them. Oh, don't do that. You're all the things that we've all heard, right? You're going to lose your home. Your kids will get nothing. You'll end up on the street. It's all this terrible stuff. And some of the bigger talking heads, like even Dave Ramsey, which I think we're going to talk about later, have come out with some real smear campaigns about the reverse mortgage. And so I just thought, what an opportunity. If you're in the privacy of your living room, hopefully shamelessly consuming our content and hopefully just learning and understanding that this is not something to be ashamed of. You are not alone. Lots of people get reverse mortgages. They get them for many different reasons. And so my hope is that through this webcast today, we can basically have that conversation about how it works, kind of real simply. It does get technical when we do an analysis for an individual person about how much equity they can access and what their options are and what their closing costs are and those kind of things. So this is going to be a little bit higher view. I do anticipate that we're going to do more videos where we'll be able to get in the weeds about really exploring those corners of the program. What is the mortgage insurance premium? How much is it? Why do they collect it? What does it do? But I don't really want to get too technical today on those things. We'll talk about mortgage insurance as it's a part of the reverse mortgages. But that being said, I think that's a pretty good idea of why we're here.
That's a good intro and a good addressing of the why.
It's probably better than you thought it was going to be,
no,
right?
It's really good. Yeah,
we didn't script all this, you guys. It's my estimation of this is that I like the old saying that if you can't explain it simply, you don't understand it well enough yourself. And so I feel like we're going to be able to explain it simply because we really do understand it well. And the idea, again, is just to empower people to learn. And in this format, have opportunity to ask questions. At the end, we'll review questions that pop up in the chat. And I want to say also that at any time during this, the viewing of this or any way that you're consuming our content, if you want to get a private one-on-one consultation, that's what we're doing. So we're happy to do that. Don't be shy to reach out. And so I think that probably the best first place to jump off is talking a little bit about the difference between a conventional loan, or as in the reverse mortgage world, they started calling these forward loans now, which I've always kind of struggled with that nomenclature. I think of a conventional loan as a regular loan, and a reverse mortgage is like the other kind of loan, I guess. There's lots of different kinds of loans.
I was going to ask you to do exactly that. And in fact, while you kind of dive in and talk about the differences between a traditional mortgage and a reverse mortgage, I'm going to put up this slide, number 3, with some bullet points about how HECMs work.
Most of us that ever bought a house in our life have gotten a mortgage. We get a mortgage through any number of places. You can get them through a local bank. You can get them through a loan broker or a big national lender. And most of them function pretty similarly. There's obviously difference in down payment, difference in closing costs, but it's been relatively standardized. And in the United States, we have kind of at the top federal level, we have HUD, which is housing and the Department of Housing and Urban Development. They sort of oversee broadly the rules that concern housing and financing of housing, a lot of housing stuff, right? And even get so far as to make the rules about construction materials and health and safety and those things. But within HUD, there are lending guidelines. Specifically under HUD, we have the Federal Housing Authority. I'm sorry, the Federal Housing Administration. It's not authority. I don't know why I still cannot commit that to memory. We just call it FHA. But these are rules about that loan program in particular. This is a government program. FHA has many subchapters to the kind of FHA loans that you can do. And most of the time when we hear about FHA loans, those are kind of the low down payment, affordable home loan options for people. FHA loans across the country are virtually the same. You can buy a home with 3.5% down. Credit and savings and those things are not as strict or stringent as other loan programs are. And so that way, FHA loans are pretty common. I think everybody's heard of them. Reverse mortgages are one of the products that's under the jurisdiction of HUD and FHA, and it is got a lot of guidelines to it. It's very clear about how everything is to be assessed and handled within a reverse mortgage, and it's overseen federally. There's a lot of disclosure, a lot of laws, and I would say too that some of the reason why there's a lot of negative misconceptions about reverse mortgages is that in years past, I think because it was a program where they were sort of figuring out how best to serve homeowners and also protect them, there was updates through the years made to protect homeowners, and kind of specifically a situation where two people may live together, and maybe in some of those old school relationships, maybe Mr. had the title to the home in his name and had ultimately chose a reverse mortgage. And then he passes away and find out that wife or significant other is occupying the home and is now being told they need to leave. And maybe they have a community law marriage. Maybe they have, some recognized domestic partnership. Maybe they're legally married and that person was never included in the loan. So that was pretty messy. There was stories of yesteryear of people being displaced from their home as a result of breaching some of these rules. Most of those rules were amended to be able to include those unique circumstances. Domestic partnership, for example, is relatively new. So these rules were amended. The program is a lot better now at making sure that the people that live in the home, as long as they're recognized of having been there at the time the mortgage was taken out, even a non-borrowing spouse like that still has some rights to be able to be in the home. So
Okay.
So going back, the conventional loan is some sort of loan. It can be adjustable, it can be fixed, but typically it's for a determined amount of time, like 30 years. If it's 30 years, there's 360 payments made over that 30-year period. You're paying each month a portion of the principal, really 1/360th of the principal, and whatever the accrued interest was. Over time, the amount of principal that's paid with each payment is increasing, so the loan balance is going down faster at the tail end of the loan, and interest throughout. On a normal conventional loan, there's a loan recorded against the property to protect and document everybody's interest. If you ever want to pay that loan off or sell that home, there's a process where that happens. Typically an interest is expressed of, hey, bank A, you have a mortgage on my home and I'm ready to pay it off because I'm either I have the cash to do so, or I'm selling it and I want to pay it off and move on. They usually will use that form to produce a payoff demand that says, when you pay us X, Y, and Z, you can have the title transferred to you or the new lender if you're refinancing, or if you're selling it, that the new owner, and you would get the balance of the proceeds. On a reverse mortgage, the loan basically starts out at some amount of money. And that is usually selected by the borrower or the homeowner. It's limited to some predetermined percentage of the equity of the home. And where it really gets different here is that there is not a required payment due. So in other words, on the conventional loan, we're paying some portion of the principal each month, and we're also paying some portion of the interest each month. On a reverse mortgage, no payment is required, which means any interest that is accruing is then added to the loan balance. Thereby, the loan balance is growing through time. The way that it works if you want to refinance a home, if you have a reverse mortgage, is just like a conventional loan. You would contact the servicer of your loan and you would say, it's my interest to refinance this loan, and they would issue a payoff demand and you would pay it off with a new refinance loan. If you had a chunk of money to pay the loan off, again, you would let them know that that was your interest to settle the loan. They would issue a payoff demand. You would pay the amount due. They would relinquish the loan. If you sold the home, you would again notify your lender that you want to sell the home. They would issue a payoff demand. When they're paid off, they would relinquish title, and you would be entitled to the proceeds. That's the difference between the payoff and the sales price of the home, just like a conventional loan. So we're going to talk later about myths, and I'm setting the stage here for you a little bit because I'm going to call back to this part of the conversation when we get there. But the bottom line is, in those ways, they're very similar. It's just really what happens to the monthly requirement to service that debt that's different between a conventional and a reverse mortgage.
So it really is like a traditional mortgage. It's just in reverse.
It kind of is, yeah. And there's a lot of nuances to it. Again, this is a higher level view of the way a reverse mortgage kind of functions and how people should think about them. I don't want to get super into the weeds about how much you could borrow or what the specific costs are or what the options are. There's options where you could set up some sort of a monthly stipend where you would get proceeds issued to you each month, like regular income. There are options where you could get a lump sum of cash. And there are options where you could get a line of credit where you only borrow as needed. There is an opportunity to combine the lump sum with the line of credit if you needed some money now to make some upgrades and then some money later for like the rainy day fund that you don't necessarily need today. So you don't want to pay interest on it today, kind of managing it that way. But that's where that starts to get into the individual conversations about
Sure.
how much equity you have, how old are you, those kind of things. I should say too, the HECM reverse mortgages that we're talking about, HECM stands for Home Equity Conversion Mortgage. That's the actual FHA sanctified title of this program. That program, you have to be 62 years old to be able to get a reverse mortgage. There are other products where you can be less than 62 or get jumbo loan balances or these other, what we'll call private label reverse mortgages. They're not under HUD. While they may be governed by HUD, it's not the same program. Those are different. We do have access to counsel people on those and give those loans if needed. For purposes of today's conversation, we're talking just about the standard FHA HECM loan.
Okay, great info. So we have kind of alluded to the reality of the myths and the stigmas surrounding reverse mortgage. Let's jump in and tackle some of those. So the first, I think one of the biggest myths where there's a real lack of understanding is that if I take out a reverse mortgage, the bank's going to end up owning my home at the end of some period.
Yeah, and again, we kind of already touched on that a little bit, but I want to be very clear about this because this is one of those things that this myth has existed through time. It must be written in the back page of some book that's passed from, parent to child or something, but it's patently false. Like we previously discussed, in the reverse mortgage, your equity is your equity, and you're making an agreement to trade portion of your equity for money today, access to equity today. But your equity is always your equity. Your equity is retained, it's yours. The bank has no right to your equity. If you get a reverse mortgage and you do what's contractually required of you, at the end of your life, like let's say you have a reverse mortgage and you pass away, whoever is going to be responsible for your estate settlement is going to have those options again of paying off the loan. Maybe there's life insurance that's determined to be, well, we take the life insurance, we pay off the home, then the kids inherit the home with no mortgage. Maybe your heirs decide that they just want to refinance it into a conventional loan. I mean, that's their right. They go get a payoff demand from the reverse mortgage, get a new loan that is sufficient to pay off that reverse mortgage, have a new loan. Sometimes whoever's settling the estate decides to sell the home. And again, we talked about that whatever that payoff is, the estate is entitled to the difference between the payoff and the sales price of the home. So there isn't a situation where HUD takes your equity from you or leaves your family with no equity, really. I mean, I'm a little reluctant to make that comment because the way that these reverse mortgages work, you can get access typically to 50% or less of your home's value. So if you have a home that's worth $1 million, they set what's called a maximum principal limit of, say, $500,000. And that number, it's not blanketly 50%. It has to do with your age. But the amount of money that you're allowed to access out of the home is pretty conservative to begin with. HUD provides some disclosures that show an assumed appreciation of your property through the years. When you review those documents closely, what you'll find is that, basically the loan is indeed growing, but also the property value is growing too. The demographic that we're talking today with this video is probably over 62. And so it's probably not hard for me to remind them that while that may sound crazy, that real estate appreciates 4% a year on average, they'll recall that, oh, yes, back in 1960, we bought our first home for $17,000. Today, that home is worth whatever, $1 million. And so it's not very much of a far cry to say that a home today worth $1 million is probably going to be worth $1.4 million in 10 years. That does sound crazy to us because it seems like how far can it go? How, can appreciation really just move on and on and on indefinitely, or do you hit some point? And I would probably argue that if you were having this conversation in 1960, that, hey, this $17,000 house is going to be worth $1.5 million one day, people would say, well, that's absurd and you're insane to imply that. But here we are. So there are situations where real estate values have corrected through the years. The what we call that financial collapse of 2008. There was a period of time where in some markets real estate values were 50 cents on the dollar. I mean, you remember that, Wes. So could there be the perfect storm of you got a reverse mortgage a couple years beforehand and took out 50% of your home's value, and then in 2008 the market collapsed and your home fell to 50 cents on the dollar and now you had no equity? Sure, you probably could find a case study where that's what happened. I would suggest that if you bought a home in 2006 or 7 with any kind of a mortgage, you probably had no or negative equity by the time that bottom was found in 2009 or 10 or wherever it was. So I say all that to go on record as to say there's not a guarantee that you'll always have equity, because those kinds of things are always going to be possible. But the goal of the reverse mortgage is to help you meet some financial need while also preserving equity that is always yours or always your estate or heirs' equity.
Okay, yeah, that makes a lot of sense, and you've answered it really, but I just want to put a frame around the next myth that I wanted to have you address is this myth that if I take out a reverse mortgage, I won't have anything to leave to my heirs, or my heirs won't inherit the home. And you've addressed that, I think, relatively clearly, but I just want to give you a chance to button that up if there's anything else you'd like to say about that.
No, I mean, practically what happens around that part of the conversation, what my experience has been is that, well, Wes, you're a father, I'm a father, which the fact that we're here also means that we're children. We had parents at least at one time. Thankfully I still have parents, and being a parent means there's a great deal of sacrifice. And I think when I look, I don't know the particulars. Did your parents inherit property when their parents passed away? I think sometimes the answer is yes, and sometimes the answer is no. I know that was really important to my grandfather, was to make sure that when he passed away, there was property that was left to his children to be divided up so that they got a little nest egg to make life a little bit easier. And I think probably most parents feel they prioritize that. And so that myth really gets legs because that's one of those corners where you can punch at the heartstrings. Well, do you really want to make a financial decision that leaves your kids no money? And this is a really, really common misconception. And I like to spend a lot of time helping people understand that that's not true. And when we really break it down, let's say you have a mortgage that's $3,000 a month. And so you get your IRA that comes from your savings that, it sells some stock or whatever. And then you use that to pay your mortgage, right? To buy down your equity so that your kids will have an inheritance. Well, would they have been just as happy inheriting the money in your IRA with a loan against your home? Um, if you have a pension where you get your pension and you just go hand your pension to the bank to make your mortgage payment, you're sort of a balance sheet at that point, almost laundering money from one spot to the other. So, I would argue in some of those situations, parents probably are going to be saving money in other ways in order to preserve inheritance to their kids anyhow, and not to go on a really big tangent here, but me and most of the people that I know, I don't want my parents to sacrifice any more for me. They've sacrificed a lot for me, and I would rather that they lived out their golden years with less stress and strain. Don't make sacrifice for me. Don't skip things for me. Don't neglect your health because you don't want to spend money because you're prioritizing making a mortgage payment to leave me and my brother's equity. You know what I mean?
Yeah.
So this is one of those corners where we almost always end up in a conversation about, I know it's important to you. It's important to everybody, but tell me about your kids. Oh, Tim's great. He's a physician. And the more they start talking, like, well, good on you. You put them through college and they're doing great. And, and then you're sitting in my office today because you're stressed. You're stressed out worried about some health thing that might pop up, and how are you going to make your 2-story home ADA compliant? Or you're worried about when your spouse dies, their pension stops, and when that pension stops, you're not going to be able to service the debt on the house. And only thing I could think of worse losing your spouse is that within a month, I need to also move out of my home where it's our memories and our familiarity. And, these are the kind of conversations that we end up in with reverse mortgages, and they're tough. It gets into those corners of the heart where we don't really want to spend a lot of time thinking and talking about that. But to me, it's kind of a necessity. And it's kind of where we end up.
Yeah, it's really where these products can be very beneficial and very helpful for people,
Yeah.
which is what you're here to educate about. So you did earlier. You mentioned Dave Ramsey. He does not pull any punches around
No.
reverse mortgages. He loves to throw them under the bus. And there's two main points that I get as takeaways from his position. So the first is the cost. So he talks a lot about the cost being exorbitant. Right. The other point is that he cites examples of elderly, especially single elderly women who end up in some kind of foreclosure situation with a reverse mortgage. So I think those are two issues that we need to hear from you about.
If this webcast makes it to Dave Ramsey, Dave, have me on your show. I will debate the heck out of you. You couldn't be more wrong. It's fascinating. I've consumed some of that Dave Ramsey comment. And, I'd say too, in general, I kind of like Dave Ramsey's gig. He's financially conservative. He's trying to get people to not do risky things, not be in debt. But he also is always, in my opinion anyway. So I guess, Wes, to know me is to love me. I'm going to give you my opinions. Wes, Dave Ramsey will tell you, oh, well, you're a fool. Sell everything you have and go move to Timbuktu in the middle of nowhere where you can live mortgage free. You can be debt free. You could have no credit card debt, no auto loan, no mortgage debt. And that's real easy to say, but you want to leave your whole life because you have a mortgage here that you're struggling to meet, or something on the horizon you're anticipating is going to take you out of your home and out of your friend group. I would argue that that's maybe one of the worst things you could do. You have this familiarity within your community, and you have your doctors, and you have your social network, and maybe your kids and your grandkids are in town. So it's real easy to say, well, don't do this. There's always other options. And if you have equity in your home that you could get a reverse mortgage with, you're better off to, sell your home and use that equity to go elsewhere. And I don't fall for that whatsoever. You brought up foreclosure, and this is a great point. Let's talk about this for a minute. Anytime you have a mortgage, you're at risk of foreclosure, right? Foreclosure is a legal process where the lender that you owe money to can force sale your home. you are in breach of contract, you have broken the rules, and they now have a legal right to pursue you to get their money back. Um, Most of us never go through that. I think people in 2008 went through that. What led to foreclosure that you're most common with? Probably stopped making your mortgage payments. Um, if you miss a mortgage payment every here or there on a conventional loan, lenders will typically work with you to create a forbearance agreement where you could catch back up, get back on track. Lenders really want to be paid. Going through the foreclosure process is lengthy and expensive. It's messy and legal. Yeah, typically on a conventional loan, why would a lender foreclose on you? You're probably not paying. Either that, maybe you're have changed the owners of the home, like you've done something that was expressly prohibited in your contract. The reverse mortgage has some rules, and there are rules that if you break those rules, they may foreclose on you. So, can you get foreclosed on with a reverse mortgage and lose your home? Yes, you can. There's very clear rules that you have to follow.
What are the most common ways that people end up in that kind of
The
situation with a
most
reverse?
common way is going to be that you are unable to occupy the home anymore. So, HUD has a rule that if you're gone for the majority of a year, so really 6 months and a day, that you need to pay your loan off. You went and traveled the world, you moved to New Mexico and rented your home out, you let your kids move into it. To be very clear, this program is not for investment property. It's not for vacation homes. It's not for you to have a rental property that you can rent to your children or somebody else. It is for an owner occupied person or people over the age of 62 that are getting this product as a way to help them with their financial security where they are. So the rule is if you're unable to occupy the home for the majority of the year, then you need to make arrangements to pay your loan off. And like we discussed previously, you can do that by writing a check. You can do that by refinancing into another loan. You can do that by selling the home. So, right after 6 months that you've been gone, you're at risk of that coming into play. If you're gone for that rule sort of is extended up to about a year if you're gone for medical reasons. So if you need to move to a rehabilitation facility, right? Or you're in some kind of assisted living type of situation with, because that's what you need health wise, then you really have about a year to be able to get back into your home. After that year mark, then again, the rules are clear. You need to pay off your reverse mortgage because you no longer live there. You're unable to live there. You can do that by writing a check, getting a refi, or selling your home. Those are really the biggest ways. The other ways that are clear is that there's a minimum maintenance requirement of your home. You get a reverse mortgage, the mortgage payment stops, you're still expected to pay your homeowner's insurance and to pay your property taxes. Those are always your responsibility. You need to keep up on them. If you fail to pay your mortgage insurance, or sorry, your homeowner's insurance, they can force place homeowner's insurance on you. And at that point, they're going to come and say, why aren't you paying this? If you're insolvent, something's gone on. Now you're going to have to figure out again how to remedy that issue. Property taxes, likewise. I mean, I think it's true for most of California. I realize people may be consuming this content out of the state of California. By and large, where we are, the county can move forward on foreclosing on your property, even if you've been on time with your loan, if your property taxes are more than 5 years past due. So we always have to pay our insurance and pay our taxes. If you fail to do those things in a reverse mortgage, that's a breach of contract and they can move forward in foreclosing your home. So I don't feel like those things are unreasonable. Lastly is going to be the maintenance. You need to maintain your home. I mean, ultimately there's a loan against your home that a lender In this case, it's insured by HUD, but they need to make sure that you're keeping up your home. That the roof is still watertight, and that there's still a handrail on the front porch, that if these things become worn to weather, that you're not just neglecting them and letting them go to the wayside. So how are these things policed? They're policed. There's usually once a year, whoever's servicing your reverse mortgage is going to send you like a confirmation where you're going to sign again saying, yep, I'm still here. I still live here. This is still my primary residence, and it has been this year. That's generally good enough. They do have some periodic inspections where they'll go knock on the door, kind of take a look. Hey, does this place look like it's being maintained? Is the grass mowed out front? Is there lights on? And that kind of thing. And if there's nobody there, they might dig a little bit further. They also have the right to do a property inspection. So there are third-party services where your servicer can pay somebody to come out, and maybe even schedule an inspection with you where they can come and look around the inside and take pictures. So that's an agreed upon, if you're getting reverse mortgage, you need to know that. But that really rounds out why you can be foreclosed on. You're breaching contract that you don't live in the home for the required amount of time you've left, or you failed to insure it or pay taxes on it or maintain it. I don't believe any of those things are very unreasonable. And just as a note too, when we think about people that are going to go, you need to go into a rehabilitation clinic or some assisted living facility. If you're going to be there for a year, sadly, you're probably not coming home. And at that point, you or whoever's helping you with your affairs probably already recognizes, hey, we have this house over here that we're maintaining, and it's an asset, and we probably should, refinance it so we could rent it and get some rental income to offset this new care expense. Or maybe we should sell it and use that money in a better way for care or whatever. I don't think those things are necessarily surprising either.
Yeah, not real different from traditional mortgage.
Actually, no, you'd be facing a lot of the same, and again, on a conventional loan, they're not going to foreclose on you because you left for a year and decided to rent it out.
Right.
That is a very, very significant difference between reverse mortgage and a conventional loan.
Understood. But the other thing that Dave talks about a lot is the cost. So I'm going to bring you back on track. And again, I'm going to throw up a slide with a little bit of information. But why don't you talk us through the costs?
Look, all loans have costs. In fact, lenders have gotten themselves into big trouble by advertising no-cost loans because what they're doing is they're cranking up the interest rate in order to generate additional interest that, are the way they make profit as opposed to charging costs. Reverse mortgages, yeah, they have a cost. And I would say by and large, the biggest cost to the reverse mortgage is the mortgage insurance fee. There's a funding fee that's 2% of the maximum principal that you're allowed to borrow. So if you get approved for, your home could technically be borrowed up to $500,000, there's a mandatory 2% fee on that gets added into the loan. Basically, it kind of gets just financed in as part of the loan balance. The rest of the fees, like the origination fee or the escrow fee, appraisal fee, those kind of fees, those are all relatively standard and customary. And by the way, on a normal FHA loan, or I would say the most common type of FHA loan, those also have a mortgage insurance premium that is functions autonomously from the government. They're not getting the origination fee or the that we talked about earlier for affordable housing. Those also have a mortgage insurance premium that is, a percentage of the loan amount funded and added to the loan balance at closing. Because remember, this is an insured loan program. It functions autonomously from the government. They're not getting the origination fee or the escrow fee, appraisal fee, those kind of fees. Those are all relatively standard and customary. And by the way, on a normal FHA loan, or I would say the most common type of FHA loan, that we talked about earlier for affordable housing, those also have a mortgage insurance premium that is, a percentage of the loan amount funded and added to the loan balance at closing. Because remember, this is an insured loan program. It functions autonomously from the government. They're not getting cash injections from the government when something happens and there's a loss, like if there is a loss on one of these properties, is imagine that down the road, they end up having to, sell one of these homes when values are down, like that 2008 example. If there's a big loss there, they don't go pursue the family for that extra money. It's not one of those loans where someone's on the hook for what's missing. It's paid for out of those insurance premiums that are collected. So this is that whole way FHA works, is to have insurance premiums that help them offset losses that happen for doing things that are kind of a little bit different than what normal lenders or investors would require out of a loan. Oh, you want to loan somebody money for an indefinite amount of time? You get a reverse mortgage when you're 62. How long do you plan to live, Wes?
Well, I'd like to live to about 100
Okay, that's a long time.
if I can stay healthy.
If I gave you a 30-year loan, you're not even 62 yet, but if I gave you a 30-year loan when you were 62, you'd be making a mortgage payment until you're 92. So if I gave you a reverse mortgage where I said, well, you can have money given to you or a line of credit that grows each year, and you can use that until the end of your life, you could live to 115. So there's sort of an indefinite amount of time that you might have this loan or this product. And so as a result, the insurance attempts to make sure that all of those premiums together mean that they're going to be able to solve weird individual cases where maybe there is money lost in one of these transactions. Or imagine too that maybe they do have to foreclose because somebody's health degraded to a place where they were negligent on their property taxes, and maybe they let their homeowner's insurance lapse briefly, and then half of the home burned down with no insurance. HUD comes through and says, hey, we're foreclosing on you here, bud. And they are foreclosing on a house that's the right half of it is burned to ashes with no insurance. I mean, they do a lot to try to make sure that doesn't happen, but that's possible. That insurance premium is going to cover it. So going back to your question, it's a criticism that it's expensive. I agree. It's kind of expensive. That being said, these loans aren't typically about, too much concern about the cost of it. Usually there's a bigger picture, or more challenges or more stress that we're attempting to solve. And again, to be real clear, I think I said this in the beginning. Maybe I didn't. I'll say it again now. I've done tens of thousands of loans in my career for people of all walks of life, including one time I did give a 30-year fixed loan to a guy that was 91.
Wow.
Was a retired Cal Poly professor, and he couldn't believe that he was eligible for a 30-year loan. He said, I'm not going to live long enough to pay this loan back. I said, well, it would be age discrimination if we said that you were ineligible for a loan because it seemed to logically exceed your life expectancy. So I've done a lot of loans for people from all walks of life. Out of the tens of thousands of loans that I've done, I'd say we've done, 1% of those are reverse mortgages. It's not the right fit for everybody. It's not the end all be all solution for somebody that has some financial stress at some point in their life. The point, and again, why we're here today, is it's an option. And it's an option that if you know about it and you can cut through what's true and false, or have a trusted partner that you could sit with and get counsel from, you can understand, okay, well, this is an option that can be considered. And we will have a very honest conversation about what happens to your equity? How much does it cost? What are your heirs going to get? What's your required maintenance expectations? All those things. I mean, it has to be thoroughly discussed and understood.
Sure. And there's a lot more questions that I've got. There's a lot of different applications for reverse mortgage. We're going to run out of
Yeah.
time, so I'm going to
It's
I'm going to
this.
say that we're going to have to do another one of these, because I know reverse mortgages. There's the potential to use it as a purchase.
Yeah.
There are tax and wealth planning strategies around a
Yep.
reverse mortgage that can make a lot of sense for individuals, and we simply don't have time to get to that. We've
Right.
only got a few minutes left, and we do have a few questions that have come in, so I'm going to give you a couple of these. Let's see, the first one here: how do I qualify for a HECM, and what are the key eligibility requirements?
On the HECM loan, first and foremost, you need to be 62. And if you're married or have a significant other, or you own a home with somebody else, maybe you and your buddy own a home together, you both have to be 62. If you're going to be on title, you need to be 62. So that's a big one. And then secondly, there's a little bit of qualification in as much as we want to make sure that you're not insolvent. If you come to us and you say, hey, I make no money, I have nothing. I was self-employed my entire career, so I'm not getting Social Security. I have no savings. I have no pension. I have nothing except for this home. I have this home where I have a $300,000 mortgage remaining on it, and I think it would be just great if you guys paid that off so that I don't have to try to drive Uber anymore to make that mortgage payment. The next question would be, well, how are you going to pay for maintenance? How are you going to pay for your taxes and your insurance? And if you pull the empty pockets out and say, I can't, I don't, we'll figure it out later, maybe Christmas gifts or something, that person's insolvent and they're not going to be able to get a reverse mortgage. That's a kind of one of those rare situations where the maximum principal limit that they're eligible for is equal to the mortgage amount and there's no money left over. If maybe their mortgage is a little bit less and they are going to be left with a little bit, there are some situations where they do what's called the LISA, the loan expense set aside agreement, and that or account, where it's kind of like an impound account where some of the proceeds will be held to make sure that those expenses can be met with some of this money. But generally speaking, we're expecting you to be able to show a little bit of income. If there's no mortgage payment, if the reverse mortgage stops the mortgage payment, and you're just going to be left with needing to pay your taxes and insurance and those kind of things, is there some money left each month? So, and then otherwise, property requirements are that, we do an appraisal. These are FHA loans. So we use a HUD approved appraiser to go out and do an interior exterior inspection of your property. They're going to measure it and photograph it. They check that the utilities are on and working, and that the appliances are on and working, and that your property is in average condition. So if you have gutted the bathrooms out of the home, or you took the heater out because it was no longer working and you're like, oh, I'll just use a sweatshirt anyway, you're not going to be eligible. We're going to have to get it up to snuff in order to be able to meet those minimum requirements of HUD standards for health and safety. But those are kind of the big bullet points. You're old enough, you have equity, you're not completely insolvent to be able to maintain the property, and that the property meets the minimum standards for a HUD FHA reverse mortgage.
Here's another good one, Jason, because especially on the Central Coast, can I do a jumbo reverse mortgage? So this is somebody asking this question that's familiar with lending and knows what jumbo means.
Yeah. So HUD has a kind of a maximum property valuation that they use. And I think that right now, and this is sort of a national figure, it's around $1.1 million, give or take a little bit. So in other words, if you came to me and you said, hey, bud, I need a reverse mortgage and I have a house on Balboa Island that's worth $11 million. So would you just be so smooth as to advance me a 50% loan to value and give me $5 million? No. It doesn't work like that. A home that's worth 1.1 million or 100 million has a maximum valuation of 1.1 million. So all of those maximum available principal access limits are going to be based off of that maximum valuation. So if you are in a market where home values are $2 or $3 or $4 million, that's like a jumbo reverse mortgage. And those products exist. They're not offered through HUD or FHA. They are governed by almost all of the same rules and oversight, but they're what we call private label. It's like a bank, an investment group says, hey, well, that's a niche. People might need jumbo reverse mortgages. And so, and we have those investors. So we have those opportunities to do jumbo reverse mortgages for people that have those real big loan amounts. I would suggest that it generally functions similar to that of the HECM, but again, that's probably getting into that nuance of let's make an appointment and sit down together and go over your personal scenario and look at what that entails.
Okay, good answer. There's let's do one more here because this is an interesting one. Again, and I bet a lot of people are in this boat due to the low interest rates that we had just not that many years back. So the question is, I have a low rate on my existing mortgage. Can I do a reverse mortgage and keep my current loan?
No. I say that again, there are some private programs that do like a reverse mortgage home equity line of credit. One of them has a minimum age requirement of 55. They still are very interested in making sure that you have a lot of equity preserved in your property. So the answer to the question for HECM is no. HECM reverse mortgage is a first position mortgage, which means they don't go behind any other loan. If you have an existing loan, it needs to be paid off either before the reverse mortgage process or through the reverse mortgage process. That balance will become part of the consideration for the reverse mortgage. There isn't an opportunity within the HECM loan to keep the loan that you have. So again, that's something that needs to be taken into consideration. If you're one of the lucky folks that have a 2.5% 30-year fix that you got during COVID, good for you. Now you need to make the decision of, if you really need a reverse mortgage, that, you're going to lose that great rate that you have on that. So again, it's something that has to be talked about and calculated.
All right, Jason. Well, thanks for spending the time with us. I do think we've accomplished the goal of putting some educational information out there today.
This time goes by so fast, Wes. I appreciate you helping to kind of document this and drive this. I'm looking forward to expanding this series where we can get into each. I'm picturing like a video library where people could go and say, oh, well, I'd like to click and look at that next one. And I want to just close this out by saying that kind of restating my goal here. I've been in the mortgage business for a long time. And I mean, I knew you when you were a spry young fellow with toddlers. And so myself and my friend group and my clients are all getting older, and with inflation and insurance costs and egg costs and all the things that have gone on, it feels like a lot of people are strained financially, and I think that and that was again kind of where this was spawned, as I started getting enough phone calls of people saying, I don't know what to do. Am I supposed to just sell my house and go to Florida now? And the sad thing is that when you look at, that used to be one of the plans, right? Sell my house and I'm going to move to Arizona. But hey, go online. I mean, we're already online. So go online and look up property values in Utah and Arizona and Oregon and Washington. You're not really escaping much anymore. It's expensive everywhere. And so I'll close by saying this product is not for everybody. It is a good product for people that are kind of, I hate to say out of options, but kind of out of options, and you're stressed and strained about things that you think are coming down the pipe in the future, health issues, loss of a spouse, pension issues, expenses outpacing your social security or your pension. And, it's like you're sitting there and you're looking, okay, well, at the current bleed rate, I have 4 more years before I'm going to be forced to do something. And, it just pains me to think that people are living like that and stressed about that. And, the reason I like having these conversations today is, you can come in, sit down, we'll talk about it. You'll learn about it. And maybe it's not even a today thing, but you'll know about it. And maybe you'll be able to help somebody down, one of your friends that it's like, well, that's not for me, but man, my friend Tom, this sounds like a good fit for him. So let's change that. Let's change that, kind of the historical way these things have happened where, it's like, I would be afraid to say, hey, Wes, what do you think about reverse mortgages? Because I brace myself. You're going to tell me what a fool I am or whatever. Let's change that and say, no, you know what? Here's a webinar you should watch or some guys that you should talk to. That is kind of a complicated product, but it can be broken down simply. And as long as you understand what you're doing and what the costs and risks and advantages are, it's a financial tool that should be considered for people that are evaluating options,
Yeah.
And I've never run my business, or my life for that matter. I find myself like, people come to me for advice, if it's, I need a plumber referral, or, my car is making a weird noise. Will you listen to it and tell me what you think? People trust me and ask me for advice. And I think that it's just good to know what the options are so you can give a strong referral. To tell somebody, well, if you're just saying, oh, well, don't do that, that's foolish. That's not very helpful,
Yeah. So, and towards that end, I want to thank everybody for taking an hour out of their day and joining us here to learn some of this stuff. And we have recorded this session, and we will make it available for anyone to rewatch, or as you just alluded to, if you want to forward this along to a friend or a family member, it will be available, and you can expect from Legacy Home Capital lots of more content in the very near future. So please stay in touch with us. If you'd like an individual consultation, get a hold of Jason, and you can reach him at Central Coast Lending or through Legacy Home Capital. What's the number for Central Coast Lending?
There's probably something you can click right here. I don't know. What's below me, Wes? This is my first time. Central Coast Lending is 805-543-5626. That 5626 is loan. So 805-543-LOAN. And our business is a low pressure environment. Like I said early on, I view myself as an expert in lending and ultimately to be a facilitator in a conversation. If you need that help, I will help you explore the corners of it, and you can make the decision that's right for you in I want to say low pressure environment, but it arguably is a no pressure environment. I'm probably not a very good salesperson for that reason. But.
Well, I can confirm that that's your approach to the business. It's one of the things that I love about you. So thanks again. Thanks for the time. We'll see everyone next round.
Perfect.